If you're in the process of applying for your first ever SBA loan, one of the first questions you're probably going to ask is about your interest rate. And that's probably because you don't know the right questions to ask because SBA lending is such an enigma. Other than this channel, there aren't a whole bunch of credible, useful places to go to get this type of information. Hey, I'm Ray Drew, an actual SBA lender, and in this video, I'm going to tell you exactly how lenders set their interest rate so that you can get the best deal for you. The first thing you need to know is that there's a lot of different SBA programs, but the main one is the 7A. That's the flagship. And on loans $350,000 to $5 million, the maximum SBA rate is prime plus 2.75%. So if prime is 3.25% today, you would add 2.75 to that, and your interest rate would be 6%. And at the start of every calendar quarter, if rates have changed, your rate will adjust accordingly and your payment would reamortize. So the first thing you notice in that example is that the rate is variable. And that's not always the case, but that's usually the case. And most people have an aversion to variable rate loans. But my advice would be to get over that quickly because chances are your SBA loan is gonna have a variable rate. I've been making SBA 7A loans for 8 years, and every single one of them has had a variable rate. But there are some banks that will fix it, usually the big national banks. They're just super picky about the types of deals they do and are a pain in the butt to deal with, and they'll tell you that straight up. But if you wanna get an insane low fixed interest rate, that's where you go. The term of the loan also plays a big part. If you're looking for a business acquisition loan or a partner buyout loan, those are gonna be done on 10-year terms. Whereas if you're gonna buy commercial real estate, that's a 25-year loan. And there's gonna be more fixed rate options available for 25-year fixed loan. Now, if I was going out to market for a 10-year loan, I would assume it was gonna be an adjustable rate. Now, aside from fixed versus variable, the rate itself can also vary. The rate's gonna be based on the overall risk of the transaction. So on a stronger deal, maybe the lender sets the rate at prime plus 1.5. And based on today's prime, which is at 3.25%, that would give you a rate of 4.75%. And the lender has full control over the pricing. Most lenders have somewhat of a predetermined pricing model. There are lenders that are actively seeking to finance fully priced SBA loans, and they're usually willing to take on more risk and offer more aggressive structures, and sometimes can even be faster. Because they're charging more, they have more to invest in hiring new people and technology to help get your loans closed faster. Now, here's where most entrepreneurs get tripped up. The interest rate is one of literally 100 different factors at play. And when it comes to SBA, going with the lowest rate option almost always comes with a cost, whether you know it or not. The most common reason a small business owner chooses to pay a higher interest rate is because of leverage. Some banks may charge more, but require less money down. If you can keep $100,000 in your bank and use that to reinvest in your business and get a good rate of return versus saving 1% on your interest rate, you're gonna make that trade-off. And it's not always gonna be as clear-cut as leverage. Like I said, there's 100 factors at play and most of them aren't gonna show up on your term sheet. Many of them have to do with how flexible a lender is, and being flexible comes at a cost. But if that means overcoming a potentially deal-killing issue in closing that perhaps came out of nowhere, that's gonna be worth paying an extra 50 basis points on your loan. Have you heard the phrase, you get what you pay for? Well, that's no different with borrowing money. Even though it may not seem like it because money is a commodity, but with SBA, the process to get to the closing table is unlike any other type of financing, and you do not wanna discount that. So don't focus solely on the numbers on the term sheet because at the end of the day, the loan doesn't close, your interest rate is 0. One more thing, since you're likely gonna have a variable rate on your SBA loan, do some research on Wall Street Journal Prime. See where it's been the last 10 years. It doesn't move much, but you're gonna wanna budget for potential rate increases in your projections, especially when we're in a low rate environment like we are now here. You never wanna put yourself in a situation where a few rate hikes can impact your business to the point where you can't pay your bills. However, most likely a lender wouldn't have given you that loan if that was gonna be the case anyway. So there you have it. If you found that video helpful and you want more insider tips from an actual SBA lender, go ahead and click that subscribe button because I've got plenty more where that came from.